Welcome, Waverly, to Startup Impact Summit. I am very thrilled to welcome you on our Growth Impact stage, talking about traversing the traction gap and architecture for scaling your business. And I'll just give a very quick introduction to the audience about you, Waverly. So in your role as Polsky Director for the UChicago Global Entrepreneurs Network, you are leading Polsky's boost efforts to better connect and support all of the University of Chicago's worldwide entrepreneurial alumni. So you teach the Global New Venture Challenge, which I'm proud to be a part of, and building the New Venture for Boost Executive MBA program, and you're a full-time coach for the New Venture Challenge. You also write quarterly for the Chicago Booth Review, and you serve on several advisory boards for startup companies, as well as the Advisory Council of OCA Ventures, a leading Chicago venture capital firm. You hold a degree in computer science from the University of Pittsburgh, and I thought a fun fact, a PhD in theater history from Tufts University. So welcome, Waverly. I'm thrilled. I'll leave the stage to you, and I'll stop sharing so you can share your screen.
Thank you for that kind introduction, Karena, and I'm really happy to be participating in this year's Startup Impact Summit. So I want to share with you an interesting architecture for helping entrepreneurs build their companies. You know, those of you in the audience who are starting a company, or those of you who have started a company, may have looked at things like the lean startup from Eric Ries that gives us the concept of the minimum viable product. You may have looked at Steve Blank's work around customer discovery. The business model canvas gave us a framework for thinking about early business models, and disciplined entrepreneurship from MIT's Bill LA gives us a step-by-step for how do you start a company. So we had a lot of help actually architecting the first, say, 18 to 24 months of our company. So we wrote our business plans and we forecasted smooth sailing. Sure, we recognized that it was going to take us a little while to get to revenue, but after that, we were going to hockey stick up. Now, those of you in the audience who started a business know it doesn't quite work this way. What we get instead is a bit of a roller coaster. And if we can't figure out how to get that traction in sales, it could kill us. It's that period of time after you launch your product, while you're trying to figure out a repeatable, sustainable revenue architecture and sales organization, that is called the traction gap. And the traction gap comes from a friend of mine, Bruce Cleveland at Wildcat Ventures, and we'll talk more about what Wildcat has done. But the important thing is you have to solve for the traction gap. I liken it to getting a plane off the ground. You know, the startup phase is you start rolling down the runway, but if you don't get enough speed, you're never going to get liftoff. And it's how do we develop that speed to give our companies liftoff? The data actually shows that if we don't traverse the traction gap in the first 2 to 4 years of our company's existence, we fail. So what you're looking at here is data from the Kauffman Foundation firm study on about 1,000 companies that started in 2004. Now, these companies did face the crash of 2008, but what you'll see is that the gazelles, the fastest running firms, the firms that were seeing more than 30% year-over-year growth, right? They survived the downturn, and you can see towards the end of the downturn, they're back on that upward trajectory. The survivors who learned how to sell in those first 2 to 4 years also make it through that downturn and get restored to the level of revenue that they're seeing. But those companies that don't learn how to sell in their first 2 to 4 years fail. Whether it takes them a year to fail, 2 years to fail, or even 7 years to fail, they are going to fail, right? What are they doing during this time? They're spending the founder's savings, they're spending friends and family money. But if they can't learn how to generate sustainable revenue, they will never learn how to generate sustainable revenue. So this is a really critical time for startups. Fortunately, I think the book Traversing the Traction Gap by Bruce Cleveland of Wildcat Ventures does for this time period in a startup's life what the whole lean startup movement did for the early days of the startup. I believe it gives entrepreneurs a framework that they can really use to make sure their business is on track and to focus their efforts in the right areas. Bruce is an entrepreneur. He was involved in starting several companies, some very large ones, and he left entrepreneurship to become a venture capitalist. And he joined with a group of other folks who also came out of the high-tech software as a service industry. And together they built this architecture. One of the advisors on this architecture is someone that you may have heard of, the author of Crossing the Chasm. So Crossing the Chasm is about getting really big, right? Lead Startup is about getting started. This book fills in the middle. So what is the framework? It begins with this period that they call go-to-market between go-to-product, which is really covered by Lean Startup, and go-to-scale, which is really build to last and good to great and Crossing the Chasm and all those books that you read to help you think about growing your company and making it really big. So what is this go-to-market period? Well, let's define some terms. We already know what MVP is. That's out of the Lean Startup. It's minimum viable product. And you have to have a minimum viable product to be selling to customers, to be in the go-to-market phase. But the Traction Gap framework adds two additional terms: minimum viable repeatability and minimum viable traction. That traction that allows you to begin that real takeoff. And the Traction Gap framework sets milestones on how you know you've achieved minimum viable product, minimum viable repeatability, and minimum viable traction. So minimum viable product is all about getting that first product into the hands of your beta customers, your early customers. There are 4 architectural pillars that you are building through this process that support your company. The first is obviously your product. And that's the one that you really focus on in the go-to-product stage. It's the set of technologies, applications, services, features that make up the offering that you're bringing to the market that solves the problems for your customers. The next architecture is revenue. And that is a business model that allows you to monetize what you are delivering, whether it's awareness, engagement, usage. How do you make money that will sustain your business? The way you achieve sustainable product and sustainable revenue is with a team, right? So you have to build a team architecture. You have to put the right people in place to scale the company. You need to develop management. You need to develop product sales, marketing, finance, HR, and governance teams along the way of this journey. Before you are able to scale, you will need all of these functions. And the last one is systems. What is the infrastructure that supports all of these activities in your organization? Front office, back office processes, repeatable things that you can develop efficiency around to help you with profitability. All of these things combined with an architecture of metrics and key performance indicators that allow you to manage it, plus a really strong culture to support the company through all of the changes that it will go through as you scale. So what Traversing the Traction Gap really does is it looks at these 4 pillars of your company and talks about where you focus, where they should be, and what some of the metrics are. So let's look at what you've achieved if you've successfully done the Lean Startup and you've gotten to minimum viable product. First, on the product side, you've got a few early users. If it's a business to business type of company, it may be 3 or 4 contracts. If it's a business to consumer, it may be a few hundred users, but 80% of your initial customers are actively using and would endorse your product. And when you made your initial assumptions about how valuable this would be, how frequently people would use it, what your customer churn would look like, you've begun to validate some of those assumptions on the product side. On the revenue side, you, the entrepreneur, and the startup team are really still driving all the sales. You're not selling a complete, robust solution. You're selling a minimum viable product. So you're partially selling vision and your ability to execute. This is not the time to have a CEO or a chief sales officer. You have to be supporting it. Your focus is really on understanding the messaging you bring to market, how you're positioned against your competitors, what the pricing should be for your solution, and what tactics you'll want to use. The team, really the people that you're hiring now are focused on getting that product ready and to market. So mainly developers, product engineers, your partnerships are going to be around supply chain for your product. The remainder of your hires in this early days are going to be customer focused. Maybe a sales rep or a customer success person. And finally, your systems are going to be really, really simple. You don't want to spend a lot of money on infrastructure when your company is going to change. You do need some basic product support systems. If you're a software company, for example, a code management base, right? And you need your financial systems in place. You need to be able to create contracts and invoices and collect revenue. The data you want to be capturing is about your sales cycle. What are the usage metrics you're getting? What are your marketing results? What's working? What's not working? The book gives you some interesting advice from a CEO about this phase for each of these pillars. So the advice from the CEO around the product architecture is fall in love with your customers. Spend your time with your end users. Really get to know what your customers need, how they use your product, and how they're responding to your product. On the revenue side, it's what I said before. Don't hire a VP of sales. You don't need it yet. No VP of sales is going to be able to present your vision the way you present your vision. Right? From a team perspective, don't make everybody a chief something officer. Right? This is not a time to over-title people. Your company is going to outgrow a lot of your early team members. So don't over-title people and only hire the top talent. So be patient and find really good people to support your business. And on the system side, you don't need much. The example that the CEO gave was in the early days of his company, it was Salesforce, email, and a website. And that was pretty much it. I'm imagining he was also using quite a bit of Excel. So let's look at the transition in these areas as you move into minimum viable repeatability. That's the indication that your company can now do things over and over and over again that will allow you to scale. So what does that mean from a product perspective? That you've delivered multiple releases of your product, that you've been able to fix bugs, upgrade features, take costs out, right? That you've done the product release more than once. A mistake that entrepreneurs often make is they think a minimum viable product is a product. It's not. It needs to go through several iterations before it will be robust enough to stand up to the market. That you have a clear product roadmap on where you're going with your product based on your customers' needs. That you're able to coordinate new releases of your product across your salespeople, your marketing people, your support teams, so that they don't cause massive disruption. A tip here is really think about capturing and sharing your customer success metrics. If your customers are lowering their costs, if they're increasing their revenue, if your end users are giving you Instagram posts that say how much they love you, use that to help you retain and influence your retention. On the revenue side, this is when we're going to formalize our marketing and sales processes. If we want to build a sales organization that will scale in the future, we have to understand what our sales cycle looks like. We have to be able to train other people on how we deliver. Same thing with marketing. We have to know what works, which tactics work. We have to know what our timing is. We really want to formalize those processes in this stage. We should have some validated metrics for things like our sales cycle. We should understand what it costs us to acquire our customers, what they're worth to us over the lifetime value, and also what our retention rates are. So we should really start to understand the economics of the revenue side of our business. The tip here is to begin using reference selling to build credibility and create use cases of how your customers use the product. That's going to help your new salespeople to really understand and position your product well. The focus of your hiring is now going to shift away from product and towards go-to-market. You're going to start to hire those salespeople, build that sales organization, marketing people, customer success people, right? You're really building the team that's going to support your customers moving forward. You have to develop formalized hiring processes. In the beginning, when you bring somebody on, everybody in the company may interview them. It may be really up to the founder, CEO. Do I like this person? Do I want to work with this person? But as you get that traction and as you speed up towards that scale, you're going to be hiring so many people. You need to put some formalized HR processes in place. The organization at this point is going to be relatively flat. Your founder CEO is going to have a lot of direct reports, and as we move from minimum viable repeatability into minimum viable traction, that's going to start to be a problem for him or her. On the team front, not everybody will scale as you grow, right? So you have to remove underperformers quickly. This may even mean some of the early executive team members that really helped you in the launch phase, but will not help you in the scale phase. You have to be able to get rid of them. Lastly, the systems. Again, we put in place our product systems and our basic financial systems. Now we want to put in place our sales systems, our marketing systems, and our customer success systems. We call that the RevTech stack, right? All of the technology that you need to support the revenue generation that you're doing. This is a time when you really want to think about, are these processes that we should be handling in-house, or should we be outsourcing them? We may be using external providers for accounting or HR or customer support, or we may need to outsource our call center or our bookkeeping, right? Are these things that we have the skills internally, or do we need more skills externally to help us scale? Don't neglect your financial modeling at this phase, right? It's really important to know during this go-to-market phase, do the numbers support your business model? In other words, is profitability on the horizon for you at a certain scale? And do you understand how to reach that? So the metrics that companies will achieve during the minimum viable repeatability phase are, it should take you about 6 or so quarters to get this minimum viable repeatability proven. The multiple releases of product, the scalable sales processes. A B2B company will be around 2 million. It's a little bit harder to tell with a B2C company. For example, if you're a consumer products company, the key metric may be around how many retailers you've gotten placement with. If you're an app company, it may be around how many downloads you've been able to achieve. So with a marketplace, it may be around how well the market is matching on the buyer and seller side. So it's a little bit more model dependent what the key metrics are for indicating that you've shown minimum repeatable viability. But it's really important that your churn rate is low, right? No more than 10% churn on an enterprise customer. And with small and medium enterprises and consumer businesses, you got to get that churn under 30% annually. And you should have a cost of customer acquisition to lifetime value of at least 3. Otherwise, it's going to be very, very difficult. Your customer acquisition costs are going to eat up so much of your revenue that you're not going to be able to build your business. So these are some of the metrics you want to be looking for to see if you've achieved minimum repeatable viability. All right, now let's move on to traction. How do we get to traction so that we can begin to scale that business to the unicorn level? First of all, our product is now that fully robust solution that we envisioned when we started this business, right? We got a minimum viable product. We've done multiple product releases. We've now added all of our features. The product is ready, robust, and scalable to go to market. This often involves many, many product releases, 5, 6, 8, right? This is not something that happens with one code base or one attempt at the product development. You want to make sure that the product is solid and firm. And, for example, Simple Mills, which makes baked goods, gluten-free baked goods, went through many, many recipe cycles to do shelf stability, taste, texture, the right mix of almond flour versus other flours. So whether we're talking about a software tech product or we're talking about a physical product, we're talking about a consumer app or a marketplace, all of these things require multiple cycles of work to get them to where you want them to be. And you've been able to smooth your release cycle so there's no disruption to your customers or the other parts of your organization when you have a product upgrade. You can now shift some of your product development to either increasing the revenue you get per account, adding more features or more products for your existing customer base, or you can begin to think about how do we expand into new markets. If your fintech company was initially targeting commercial banking, can it now target real estate investment? Can it now target insurance, right? So moving to new market segments or new geographies. On the revenue front, you've shown continuous quarter-over-quarter growth. This growth may or may not be really smooth, right? But you're growing. A lot of B2B companies find that their yearly revenue cycles bump up towards the end of a year when companies are in budgeting cycles, and then kind of slow down in summer months. But you're showing quarter-over-quarter growth that you're really scaling your sales organization. You're working on developing higher revenue per customer, or if you're a consumer company, per user, so that you have more revenue with each of those sales. And you're starting to get your revenue from more than just one market and one product. Your team should be fully fleshed out by now. You need all of the critical elements in your management team to run your business. A head of operations, a head of revenue, a head of human talent, all of those pieces should be in place before you really hit the gas to grow big. And your organization is starting to become layered. You're starting to develop middle management. You've separated your sales perhaps into internal sales and external sales, or small accounts and large accounts. You're starting to develop those layers within your organization. By now, your company has definitely outgrown some of your early team members. On the systems front, your technologies are connected. So you don't have to manually download data out of your Salesforce into Excel in order to put it into your accounting system. You've connected the pieces, right? This is going to make your efficiency a lot better. You've developed processes and training that allow new hires to come on board quickly and be effective really quickly without all the involvement from the original founding team. And your data collection is giving you more details about your key performance indicators, about your metrics, so that you can really work on efficiency. And that's where your profitability is going to come from. So there are some key warnings that things aren't quite right in this phase. On the product side, it's incredibly important with your development people that you maintain focus. Entrepreneurs always have new ideas. I call it the shiny object disease. Well, we would be capable of doing that. We could do that. And you start to stretch your product organization too thin. You've got to stay focused on your core deliverables and add incrementally as your customers need it, not as your product people get excited about it. From a revenue perspective, not all customers are good customers. Entrepreneurs think they have to say yes to every customer. But oftentimes, particularly in a B2B context, if you're dealing with large companies, they may ask you to do things that, again, stretch your development team or your customer service team too much. Or you may find that there are customers who are so focused on price that the margins are simply not worth doing. One entrepreneur said one of the most empowering things he ever did was he fired a customer. He said he really needed to learn how to do that. Not all customers are good customers. Some of them will actually hurt your ability to scale. From a team perspective, you got to be a little careful in this phase that your growth isn't disrupting your culture. It's really important to maintain your values, and there's a real temptation here to use less than ethical methods to get more revenue, less than ethical methods in competition. Your values can really suffer during this phase if you take shortcuts, and that's something you just have to be aware of as an entrepreneur. Don't put so much pressure on your sales team that they're doing things that you later don't want to have to fix. From the system side, don't neglect that you have to achieve profitability someday. And I think in this time of Corona, this is one of the most important things I need to say to entrepreneurs. This period, when you're in your go-to-market period, you need to have two business plans available to you at all times. One is your optimistic, aggressive, scale fast, become a unicorn business plan that you use with investors to help you get the funding you need. But the other business plan that you keep in your back pocket is, how are we going to operate this business lean? It may mean slower growth, but how are we going to operate this business lean so that we're at least cash flow positive, so that revenue is funding what we're doing? Because we may not be able to get outside investment in a time of crisis, particularly as that crisis continues to affect the economic markets. Right now, angel and venture funding is looking good, debt is accessible, but as this crisis drags on, that could change. Make sure you know how to adjust your operations to fund yourself with revenue. So what are the metrics that you will have attained if you've successfully gotten to minimum viable traction? Again, this should take you about 4 quarters, again, quarter over quarter growth. So once you've hit minimum viable repeatability, minimum viable traction should come probably within the next year. If you're a B2B company, 6 million. If you're a B2C company, whatever your metrics were in that minimum viable repeatability phase, you probably are going to triple those metrics. So whether it's users or retailers carrying your product, whatever the correct metrics are for your business. Your users, the people who are engaged with your product in general, 25% of them should be very, very active on a daily basis or a monthly basis, depending on your type of product. If what happens is a lot of people download your app, but only 5 or 10% of them actually interact with it, it's very, very difficult to scale. Same thing with a B2B product. If the enterprise is only using your software occasionally and not on a monthly basis, chances are when it's time for budget cuts, they're not going to renew. right? You want some virality. You want customers helping you to bring on new customers, word of mouth marketing. Are you getting at least one new customer through referrals for every 5 enterprise customers you have? Are you getting at least one customer for every consumer customer you're getting? In other words, what's your net promoter score? Are your customers telling their friends they really like what you're doing? Okay, these are the kinds of things that will lower your customer acquisition costs over time. So what does it look like for successful companies who have gone through and managed this traction gap and gone on to scale? The team at Wildcat Ventures has an enormous amount of data on what happens with big software as a service enterprise companies. They have a lot less data on other business models, and I've asked them to address that. But one of the key metrics out there that actually comes from Battery Ventures is called the triple, double, double path to $1 billion valuation. My students often ask me, can you really get to 100 million in sales in 3 to 5 years? And the answer is, for certain companies, very much yes. So what you're looking at here are some of the big SaaS wins of the last 10 years or so: Zendesk, Workday, Marketo, and this triple, double formula that was identified by Battery Ventures. And what they're talking about is what's happening with your revenue each year. If you get on this path, chances are pretty good the VC community is going to continue to invest in your growth, your valuations are going to climb, and you're going to have a really great outcome. So everything I've been talking to you about so far has been about the traction gap, specifically as defined by Bruce Cleveland and the Wildcat Ventures group in the book Traversing the Traction Gap. For more help getting through the traction gap, I can recommend these books. The Founder's Dilemma and Leading at the Speed of Growth are incredibly helpful for thinking about your people architecture and your systems architecture. And Hacking Growth and Predictable Revenue are really, really helpful on scaling that revenue architecture that we talked about. So I hope this has been useful to you, and I'm really excited that I got to be here with you today. Please reach out. My email, waverlydeutsch@chicagobooth.edu. Thanks.
Thank you so much, Waverly. This was brilliant. And maybe if you could stop sharing your screen, fantastic. And then we can absolutely get both together here again. Fantastic. Let me put this here. Amazing. I love frameworks. So, you coming and presenting a framework, fantastic, and it's interesting. I just want to zoom in a little bit. So I learned now there's not only MVP, but there is MVR and MVT, right? And let me try to put this with another framework. I mean, thanks to Peter Thiel, we make this distinction between from 0 to 1, and then from 1 to 1,000 or to 1,000,000, etc. So how do you define? So what I understand is then that minimum viable repeatability is probably then. So not from 0 to 1, that's your MVP. So you have now from 1 to 3 to 5 to 10, so you can repeat it, right? And then there is this from then the 10 to 1,000, 1,000,000. But how do you distinguish? What makes it traction versus repeatability? Is it because you can scale customization, or can you standardize better? I mean, what is it?
I think there are a couple of things that really happen between repeatability and traction. And one is that you stop doing everything yourself, right? So the founding team is involved in so much of the business early on. It's when you're able to delegate things, and so you're able to bring on more people who can accomplish the same goals in the company, that's when you really have traction. If you have to do it yourself, you're going to flatline, right? Because you're going to become the bottleneck. So if the entrepreneur can't let go of the product processes or the sales processes, right, or the people processes, that's going to flatline the repeatability, and you're not going to get traction. You're going to get to a certain level of speed and you're not going to get traction. So for me, a lot of what happens with traction is the ability to take the knowledge, expertise, frameworks, processes that are in our heads as a startup team and really get them into defined systems that the company can use to build itself. It's funny, I say to my students, investors invest heavily at the seed and Series A stage in the founding team because the founding team is making everything happen. By the time you hit traction, investors can invest in the company. If I have to replace the founding CEO before I've hit minimum viable repeatability or even minimum viable traction, there's a real chance the company's going down. There's too much that's based on what's in the minds of the founders and the founding team. After minimum viable traction, we want to hire a growth CEO who does different things than a founding CEO. And to me, that's the critical difference.
That's brilliant. You know, I thought I asked you a question about product and you answered it with the team question. I love it. So again, you know, the team always stands at the core and the center of the success of the company. Another thing you mentioned is about, you know, Bruce actually having been an entrepreneur and then turned VC. So again, what do you think? It makes him a better investor?
Absolutely. I think venture capitalists and angel investors who have operating experience in startups, whether as a founder or as an early stage employee, you know, if you've gone through that scaling process, if you truly understand that feeling of you're trying to put together the car as it's racing down the hill, and if you don't get those brakes installed, you're going to hit that wall. That feeling of chaos, that feeling of constant change, then you're in a much better position as an investor to support the company through that. I think it's really, if we look at the mistakes that were made during the tech bubble, people got huge amounts of venture capital and they didn't know how to spend it. They got office space and Herman Miller chairs and foosball tables and free beer Fridays, but they didn't understand how to architect the real systems of their business. Investors who are entrepreneurs are not going to let their entrepreneurs make those kinds of mistakes.
Brilliant. And you know that I will not let you off the hook without asking you a question about an international view and comparison of entrepreneurship, the startup ecosystems, because you, with your Global New Venture Challenge, you travel around the world, right? So give us a little bit your insights. I mean, obviously one question always pops up, you know, East and West, is there still a gap? Yes, no, but just in general, I mean, how would you characterize like the different trends and the different geographical regional differences?
I think there are things in the startup world that are universal. So I believe that frameworks like the Lean Startup or Traversing the Traction Gap are applicable to all entrepreneurs. But there are cultural differences within those frameworks. A really good example of this is I was visiting with some of our alumni in New Delhi, and they said, you know, nobody taught us that in the sales process in India, no one ever tells you no, right? So it's very hard to get to a no in India, which is kind of, you know, surprising for, say, Western entrepreneurs who get a lot of no. The Indians always kind of want to keep their options open. Another example, in Asia, in an early meeting with an investor, you don't talk money. In the US, the investors want to know immediately, how much are you raising? How long will it last you? What valuation do you want to raise it at? In Asia, it's really important that you go on your early investor meetings to build the relationship, to ask for help and advice, and get to money a little bit further down the line. So there are some cultural differences that way. There's also the overall culture of a company has a huge impact on the nature of entrepreneurship in that country. So for example, in India, there is a very high degree of entrepreneurial activity, but a very low degree of thinking big, right? So you have lots of the population involved in trying to build businesses, but they're trying to build small businesses. Culturally, that's an issue that investors in India have to work to find entrepreneurs who have that bigger vision. In China, sort of the idea that you would try something and fail and try something and fail works really well, right? It's fine. You know, you do your best, you figure it out, you keep going. In Japan, no. In Europe, no. You fail once, you don't get another chance to be an entrepreneur. So there are cultural dynamics as well as economic dynamics that make how entrepreneurs go through these processes specific to their geography. But the processes themselves are really applicable worldwide.
That's very, very interesting. We do have another talk actually during the 2 days, which is called Innovation the China Way. So again, I think it really brings up some of the commonalities, but also some of, as you mentioned, the cultural differences. Now, talking about China, and I have to get again a little bit like a comment on you on gap or no gap, East versus West. So Startup Genome just, issued their most recent report. In the top 10, we have 2 Chinese cities, right? And then obviously dear to my heart, Hong Kong and Shenzhen, who are part of what we now call the Greater Bay Area. So soon the largest Bay Area in the world. So larger than the Tokyo Bay Area, larger than the Bay Area from the US, and actually giving birth to nearly 50 unicorns. I mean, if we would just measure the success of an ecosystem by the number of unicorns we produced, so not even in the top 20. So is there still a gap or no? Or is it just what's happening?
So I think Shenzhen and Hong Kong may be suffering what Chicago suffered for a really long time. And that is when your startups are serving sort of a local market, the visibility of them is less. So Chicago had enormous innovation in the 90s and early 2000s around the printing industry, the food industry, but these were not the celebrated, tech internet successes of Silicon Valley. So when I moved to Chicago in 2000, there was an article that was the cover of Business Week. How did Chicago miss the entire tech boom? Let me tell you, it made Mayor Daley very, very unhappy. So we may be in a period of recognition, right? Particularly with Shenzhen, the Shenzhen area. Obviously, venture capital moved very strongly from west to east into Beijing and Shanghai with Sequoia and many others. Those geographies are now really well recognized as hotbeds of entrepreneurship. I wrote an article in the Chicago Booth Review called Don't Underestimate China's Entrepreneurs, and I probably shouldn't tell you what came after the colon, because what came after the colon was steal them. But the rapidity with which China in particular has caught up in terms of patent creation, venture capital raises, unicorns, the pace of change in China has been remarkable over the last 2 decades. What's to steal them about? China still loses the most immigrants with patent-holding immigrants. So let's say that the US still holds a quality of life advantage for entrepreneurs over China that I think the current administration in China needs to be aware of.
Very interesting. But just talking about patents, and I do have to do a little bit of advertising because I fully agree. I think we just lack the visibility. And one of our reports, about now the Greater Bay Area startup ecosystem tries to shed light, right? But still 50% of all patents filed in China come out of Shenzhen, right? And I would argue, DJI is probably the only consumer products company in the world where the market leader is Chinese. Tencent, right? SenseTime, the highest value AI company in the world, is a Hong Kong, Shenzhen, product. Anyway, so I'll hope, very soon, and maybe with Startup Impact Summit, we can also make a step in the right direction. And at the end of the day, I always love to say it's not either or, because startups are meant to go global. You have to be able to operate in all markets, and making these bridges is something we're super thrilled about. So that's why it's always such a huge pleasure to have you, Chicago booth, Polsky, and particularly you, Waverly. Thank you so much. It was brilliant to have you with us.
Oh, Karina, it was my pleasure.
Thank you.